This is Kevin Dugan, reporter for Money Management Letter, and with me I have Ari Bergman, founder and principal at Penso Advisors. Penso is a risk management firm that specializes in assessing and hedging systemic risk for hedge funds and institutional investors. Mr. Bergman founded the firm in 1997. In 2008, Penso launched the Global Crisis Fund, which took advantage of global volatility and mispricings in the global market. Before focusing on systemic risk, he was senior managing director at Bankers Trust, where he headed the firm's transaction development group. He was also one of the first to create and implement swaps on hedge funds. Today, we're here to talk about different kinds of risk and how plan sponsors and asset managers can insulate themselves and what they may be doing wrong. Now, Mr. Bergman, we spoke once before about different allocation strategies that are being used by funds like CalSTRS, CalPERS, New Jersey Division of Investment, just to name a few. They each have their differences, but they essentially put risk in different buckets. What do you see as the advantages and disadvantages of these approaches?
I think the advantages, the risk-based approach to investing is very healthy and very good. I think that risks should be measured as a function of returns, and returns are a result of risks. Therefore, dividing them into buckets is extremely helpful. Asset classes are not as important as risk classes. Risk classes allow you to decide what risks you want to take, and are you getting rewarded for them. The big issue with that is, how do you allocate risk? Risk is not always very clear, and risk is not always very obvious. You've got to decide what is a risk and what are you really getting paid for it. And that, I think, is the critical problem that you have.
How should they determine which kinds of risk buckets they should group their assets?
I think the risk buckets that should be done needs to be evaluated if different institutions will have a different risk approach. So in other words, some institutions will realize that they are faced with X, Y, and Z risks, which are the most difficult to hedge, or the most, they're not optimal for the current environment. So you've got to decide what is the best risk for your kind of institution, and what kind of risks are you getting paid in the environment. Function of the environment and function of your institution. But you need people who understand risk to help you assess of what it happens. But it's very individual and tailored by client. That's why our job, when we work with clients, we are firm believers of a tailored, bespoke mandate to analyze the client, their needs, their cash flow projections, to know what risks they should be taking and what risks they need to avoid.
What are some of the issues with risk buckets? What are some of the ways that there could be shortfalls with that kind of strategy?
When you go ahead and you decide something is a specific risk, because of the systemic nature, today the risks are very much correlated. Correlations go to one. So one of the big issues is correlation. How is that risk going to be affected by a different risk? Second issue, many times things which appear to be risk-reducing strategies or risk-reducing buckets are actually increasing your risks and might not be obvious. Typical example, cash. Cash was always risk-reducing, but today it might be risk-increasing because of inflation issues. Gold and certain commodities. Some people view this as a risk-reducing asset to protect you against inflation. But conversely, it's a very much of a risk-increasing asset if there is some kind of a deflationary issue or if there is some kind of monetary policy tightening. And therefore, it's not obvious, number one, what the risks are they independent or correlated? And the second issue that you have are these risk-increasing buckets or risk-decreasing buckets, and how will they affect you?
How is it that plan sponsors can more clearly see correlations between different kinds of risks?
I think the correlations are not static. Correlations move. And I think the correlation assessment needs to be made on a very much of a timely, periodic basis. And you have to stress correlations, because what in a time of systemic risk, in a time of stress, in a time of financial upheaval, not only volatility increases, but what's most important, correlations increase and change. So number one, you've got to stress your correlation assumptions. And what's important, you have to review it on a very much a periodic basis, because this is not static, it's constantly changing and moving and needs to be addressed and dealt with.
Mm-hmm. Is left-hand tail risk, the so-called black swan, is that still an issue for managers today?
I think the issue will always be there. See, we approach risk not the black swan or the fat tails, this one in a lifetime events, or we call the 5 standard deviations. I think what's important are systemic risks, which are also fat tails, but they are much more common, and in my view, they will be much more prevalent in the markets right now. We are at the end of a large debt cycle, which by nature we have increased the leverage in the system. We have many imbalances in places, which means that these kind of events, what we call systemic, that affect all strategies, all geographies, and all asset classes, and they are the headwind that can derail any strategy, are here to stay and will be even more common. The fat tails, those very, very rare events, the black swans, continue being rare events. And it's very difficult to say when they will hit you. But the reality of it is, Kevin, most of those risks, the systemic risks out there, which people call black swan, they were not so unforeseen. If people would have paid attention to them, they were almost obvious. If you look at the crisis of 2008, it's not a black swan. People, as early as 2007, including ourselves, foresaw the problems, were able to hedge efficiently and cheaply. So that's not a 5 standard deviation event. That was very clear. If you don't plan ahead, if you don't think ahead, you might think that that's unforeseen. But not every event that you miss in the horizon is a black swan. The same thing happened 2 days ago. Commodity silver had a huge move, a 35% move. We could call that a 5 standard deviation move. But for market participants, people who are watching risk, this was expected and was there to happen. Just because you didn't expect doesn't make it a black swan.
Are we at a time now where correlations are going to be higher, just as a standard rule?
I think that correlations are going to be higher. That's number one. Just because we are in a global environment, we have a lot of macro events, and the increase in leverage, which has happened over the past 20 years, by nature increase correlations. You are always as strong as your weakest link. So if one weak link goes out of control, the whole system goes bust. That's number one. I think also you're going to have a lot more of instability of correlations. Correlation patterns might change overnight, and you have to stay aware of it. To our clients, we review the risk periodically. We have basically at least monthly meetings, sometimes a lot more often. And what we do is review the systemic risks in the horizon, the changes in correlation, and how it will affect and impact portfolios. But we are in this period of what's called correlation instability to stay.
From the asset manager's perspective, what are some strategies to be mindful of right now when assessing risk?
The strategies of assessing risk, I think the right approach, again, there's several approaches out there. You have some commingled funds that it's not the risk assessment, but they just portray to be a fund which will make money in times of greater correlation or greater risk. That's one approach. Our approach is very different. We believe in the tailored approach, as I told you, bespoke, which means that you've got to go ahead and look at each individual portfolio and look in the horizon and say, okay, what are the icebergs out there? And how can they affect my portfolio? What will be the risk or the effect that it will have in my strategy or my portfolio? That's number one. Number two, determining, okay, what do I need to get paid if that happens? And number three, is to find mispriced instruments which allow you to create a hedging strategy which is both cheap, leveraged, and efficient. But this is the approach. The idea is that you have to be mindful to your portfolio. What out there can hurt you? And the problems are many. We have sovereign issues, we have monetary issues, we have fiscal issues in this country, and these are all sources of risks that will come to bite you, and the question is how and when they will impact you and how to protect yourself against it.
Some different strategies like risk parity and liability-driven investment, are those worthwhile today, especially those two?
I look at those. These are valid strategies. And see, risk parity. Let's start with risk parity. Risk parity is very similar to our own approach, which is RAROC, the risk-adjusted return on capital. The risk-adjusted return on capital is an approach that was developed by us at Bankers Trust almost 20 years ago. And the approach is that you get paid for risk, which means that when you build a portfolio, asset allocation is not enough. You need risk allocation, and that's risk parity. Now, the issues of risk parity are that it would work on lower yield environments. In other words, when bonds are rallying because yields are coming lower. So the idea of taking your bond allocation, leveraging it up to create a parity between the risk of bonds and the risk of equities, but not by reducing equities, but by increasing bonds through leverage. It worked in a rising bond price environment, lower yields. However, as deficits increased, monetary policy has been so loose that we are at the end of the rope. We are going to start a rising rate environment. If you look at the 1994, when yield rose rapidly, such a strategy, which is a leveraged bond, is extremely dangerous. And the reason is because correlation, number one, and volatilities are not static. Risk parity, to be able to create your buckets, you need to assume a volatility for each bucket, and you need to assume a correlation. In a way, times like today, which these are very unstable, it might be a dangerous proposition because of the leverage on bonds. So it is valid, but there are shortcomings, like everything else in life, and you've got to be aware of it. Liability-driven investing is a problem because if you really try to maintain a match to your liabilities, you've got to go a lot towards fixed income because they provided fixed cash flows. The issues are we might be at the beginning of a declining bond price, meaning a rising rate environment that your portfolio gets hurt. Number two, the returns which bonds are providing today, it's so low because it's driven by the Federal Reserve. The Federal Reserve has created a negative return environment for bonds. We are yielding because of QE2, and it's like we have created an environment where bonds give you returns below inflation. So you're eroding your portfolio. So the liability-driven management focuses too much on fixed income because that's the only way that you could actually match your liabilities. But it might not give you enough returns. And in a world where bonds are going to perhaps decline rapidly and yields rise, it might be very, very painful and very hurtful. The paradigm might be changed. We, in our way, approach differently. We look at the world that you've got to do the risk parity exercise, which is measuring risk and having your returns as a function of risk. But you could play with the risk equation, not through allocating to bonds, but by creating a portfolio of hedges which are alpha producing that allow you to monitor or to create a bond-like risk and return without the downside of bonds that might come if rates rise rapidly. So the approach is right. You just have to tailor to yourself using clever strategies to achieve it in a way which produce returns and not hurt you if there is a change in the rate environment.
Gotcha. Well, that pretty much brings my questions to a close. Thank you so much for
Thank you very much for the opportunity. Thank you very much.